Welcome to your online lectures for tax processive businesses. Here we've got lectures that take you through the entire unit. We've also got assignments and mock exams for you to practice. So in this unit we're going to look at the knowledge that you need to calculate, prepare and submit value-added tax or VAT returns to HMRC. We're also going to look at law and how companies can keep compliant with the rules with regarding both VAT and payroll. So if you're on the level 3 certificate in bookkeeping, this exam will count towards 30% of your overall grade. If you're on the level 3 diploma in accounting, this exam is 15% of your overall grade.
Welcome to this session. My name is Anne and I'm going to be taking you through a little bit of terminology where we're going to learn about HMRC and more specifically a type of tax that they administer known as VAT. That's a type of indirect tax. Let's start then with HMRC and a little bit about how the tax system in the UK works. So it's actually the responsibility of the government to approve new tax legislation, and this is done once each year. You may know that the Chancellor comes outside of number 11 Downing Street, stands there with the briefcase, poses for some photos, and in that briefcase is details of proposed changes to tax legislation. When those changes have been agreed on by Parliament, they become a Finance Act, and we have a new Finance Act each year. So taxes in the UK, once they've been agreed on by Parliament, form part of the Finance Act, and the Finance Act is actually administered by Her Majesty's Revenue and Customs, or in short, HMRC. And HMRC are really the government body responsible for making sure that organisations pay the right amount of tax, making sure that they comply with the tax and in our case the VAT regulations. And because this paper is primarily about VAT, we're going to be having a look through the syllabus at things like whether an organisation has registered for VAT, have they kept appropriate records, have they submitted returns on time, how do they make a payment. So HMRC are actually responsible for a whole range of taxes, but the one that we're primarily focused on in this unit is going to be VAT, although we will look later at some other areas too. So a bit more terminology for us here in terms of what is an indirect tax. And I suppose to understand an indirect tax properly, we have to also understand what we mean by a direct tax. A direct tax then is one where the person responsible for that tax pays it directly to the government themselves. So corporation tax is a very good example of this. A company for a particular year makes a profit. That profit is then taxed and the company pays that tax directly to Revenue and Customs. That's why it's called a direct tax. Inheritance tax is another example. If there was to be an estate and the estate then has tax that needs to be paid on that estate, then the estate will pay that tax directly to Revenue and Customs. So that is our first bit of terminology, direct tax. So how is an indirect tax different then? Indirect tax, and for our purposes, the indirect tax we're going to talk about is value-added tax. This is tax on a transaction. So for example, a tax on our spending. Some countries refer to this sort of tax as a sales tax. In the UK, we call it an indirect tax. So if we think about then a situation where we maybe go out and we buy a chair. We buy a chair from a VAT registered trader and we pay £120. Now, unless we actually look very closely at our receipt, all we know is that we've paid £120 for the chair. That was the price on the chair, that's the amount that we paid when we got to the till. What we may not realise, unless we look at our receipt quite carefully, is that the £120 that we have paid is made up of two parts. It's actually £100 for the chair itself, and £20 VAT. So the chair actually only costs 100, but we paid this £20 of sales tax on top of that, meaning the total cost of the chair to us is 120. Now, from the point of view of the person that is selling us this chair, they're only getting to keep 100. So they get to keep the price of the chair, but the VAT that they've collected from us doesn't belong to them. At some stage, they will have to pay that VAT to Revenue and Customs. So you may, in future, like to just start checking a few receipts. Next time you buy something, be it something when you go out to buy a sandwich and you get a little till receipt, or you go out and buy something like a TV, a little bit more significant, have a look at that invoice or that receipt. See if you can work out how much you actually paid for the item and how much of what you paid was VAT. I wouldn't recommend doing it for too long because it can get a little bit depressing, but yeah, definitely worth having a look so you can understand a little bit more clearly that this indirect tax is levied on the majority of things that we buy. We'll have a look later at which items are subject to VAT and which ones are not. Now, at the moment, the rate of VAT on what we'd call standard rated items, that's going to be most things, is 20%. So what's happening here is the person that we are buying the chair from is called an intermediary. And the reason we call them the intermediary is because they have the job of collecting the VAT from us and then paying the VAT to Revenue and Customs. So they're acting like an unpaid tax collector. Revenue and Customs have appointed them to collect the VAT from us and to pay it over to them. So you can see it's not paid directly, it's paid via the intermediary. That's why it's an indirect tax. Now, VAT isn't unique to the UK. Lots of other countries also have VAT, and it comes with a wide range of different names. So VAT in the UK or equivalent sales taxes elsewhere. VAT and the UK system, of course, is the one that we are focused on here. So as a reminder, VAT is a type of sales tax and it's a tax on consumer spending. It's a hugely important source of revenue for the government. They collect lots of tax revenue through the collection of VAT from us. And it's us, you and I, as the final consumer. And by consumer, I mean somebody that's not registered for VAT, somebody Joe Bloggs just going about their normal, ordinary business. It's us that will bear the ultimate cost of VAT that's being charged. Now, this VAT process is actually quite a long process, and we'll see an illustration of that later in this chapter. But the process starts where the supplier registers for VAT and says, I would like to be a VAT registered supplier. That will involve some paperwork. They'll be given a VAT registration number, and we'll see again later some conditions that are needed in order to register for VAT. Once somebody has registered for VAT, that means when they sell taxable goods, they have to add VAT on, like our chair. Once this person has registered for VAT, they have a chair. They can't just sell it for £100 now. If £100 is how much they want to keep, they must add the VAT on top. Now, some very important terminology follows here, starting with this phrase output VAT. Each time a VAT registered business makes a sale, it must, so not might or if it wants to, it must charge VAT on the value of the goods and services it provides. So once somebody has registered for VAT, and throughout the course we'll learn about whether they have to register for VAT, if they have a choice to register, but for now we're assuming they have registered. They've spoken to Revenue and Customs and become a VAT registered business, and in that case they must now charge VAT on the taxable goods and services that they provide. And the VAT that they must add on to the value of their sales is called output tax. And you can remember this one perhaps by thinking about sales being goods that are going to go out of their business. They've sold them now, so the goods going out have output VAT added on. This VAT is added on top of the sales price. So it's 20% for standard rated VAT, which would mean if an item costs £50 without the VAT, the VAT will be 20% on top of that. So we work out 20%, 20% on top of the £50 gives an extra 10, meaning that the price of the item is now going to be the full £60. So a little bit more terminology for us here. We would call the net price the figure without VAT. The VAT is then added on top of that, and that will give us something that we would call the gross price. And we'll see this terminology also later through the course. So net is the figure without the VAT, gross is the figure including the VAT. So we've learned about output VAT. Remember that output VAT is on the sales, on the goods going out of the company. So what do we think the input VAT might be? Well, you might have guessed it. This is the VAT on goods coming in to the organisation, because as well as selling things, our organisation is going to buy things. And when the organisation buys things, they may be paying for the goods and also paying some VAT that their supplier is charging to them. So when a business that is VAT registered purchases some items and there is VAT included on those items, they can reclaim this VAT, and we call it input tax. The tax that they are paying on goods that they are bringing in to their organisation. Now, only VAT registered businesses can reclaim this input VAT. As individuals, as consumers or non-VAT registered people, we cannot reclaim this VAT. So when we buy our chair for £100 and VAT gets added on and we pay £120, that to us is the price of the chair. There's no further conversation. However, if our VAT registered business was to buy a chair for use in the office, perhaps, they would be able to reclaim that £20 of VAT. So as individuals, we cannot reclaim the VAT. We would suffer the full cost. However, if we were a VAT registered business, then we could reclaim the VAT. So if we stick with the example that we had here, our item for £50 with VAT of 10 and a gross of 60, if that item was purchased by a VAT registered business, they would pay £60, so they would spend £60 from their cash, but they would be able to reclaim £10 from revenue and customs, which means the actual price to them of the chair is actually only 50. Yes, they paid 60 to begin with, but they're going to be getting 10 back, so they're only actually paying the net cost of 50. So how does this actually work in reality then? What's the system? Well, administratively, you can imagine it would be incredibly difficult if we had to deal with the VAT on each transaction individually. Think about a large company, say like Marks and Spencer's. If they had to account for the VAT on every individual transaction one by one through the day, that would be hundreds of thousands of transactions each day. It's just too much. So they can't pay over the VAT one transaction at a time. What happens is things get grouped together. So every time they make a sale and they collect some VAT from us on the item that we've just purchased, they keep a record of that. They then keep a record of all the items that they've purchased, all the VAT that they have paid on things throughout the period, and then they gather everything together. So all the sales made in a particular period, let's say it's a 3-month period or a quarter, are added together. All the VAT on things that they've purchased over that same 3-month period is gathered together, and we then net off one with the other. And this is all done through the preparation of a VAT return. So the VAT on the sales the VAT on the purchases is collected together for the time period. It's added up and it's summarised on the VAT return. Usually that's done quarterly. We'll see throughout the syllabus there are other options, but usually that's done quarterly. And what they're doing is they're adding together all the output VAT to get the total output VAT. That's the amount that needs to be paid to Revenue and Customs. So let's say the amount to pay in output VAT is maybe £1,000. They then add together all the input VAT. This is VAT that they've actually already paid. When they've bought items from their suppliers, they've paid for the item plus some VAT. So the input VAT has actually been paid as they've gone along. So we add together all the input VAT that they've paid. This can be reclaimed from Revenue and Customs. So let's say that during this particular period, the input VAT comes out to be £600. We can then net off one against the other. So we can see in my example here that this particular organisation needs to pay £1,000 to Revenue and Customs, but it can reclaim